Welcome to the presentation of Infront ASA's Q2 2020 results. With us today, we have, as always, our CEO Christian Nesbæk and our CFO Max Hofer. There will be a live Q&A session at the end of the presentation. If you would like to submit a question, select Q&A on the right side of the screen and follow the instructions there. Now, over to you, Christian.
Hello everyone, welcome to this presentation and thanks for taking the time. It will be worth it. Infront is a company that helps our customers gaining a unique market insight and the help they need to taking the right decisions. We are a full-service financial solution provider that offers a wing-to-wing solution to the advantage for our clients. We cover everything from web solution for private investor to professional analytics and trading solution. We have also fast and content-rich data feeds with calculation and validation service. We have a history of a very strong growth. The revenue has increased with 500% over the last 4 years. Our coverage has increased to more than 120 exchanges and we have more than 8 billion daily data points. We have offices in 10 countries with around 3,500 customers. Infront offers application or software with content, and since the content or service part is vital to our offering, everything is sold as a service, software as a service. The software is not worth anything without the service. This is sold as a subscription-based model where every customer pays a monthly fee to us based on the delivery and the number of users. Very simple but attractive business model. Harvesting cost synergies from our latest acquisition is still top priority and will be so for a while, and it's also the result of the work that can be seen in today's record high adjusted EBITDA. The rebranding of all the companies in the group is now complete. We have in this quarter focused on aligning and tailoring product portfolios so we can cross-sell in our markets. Behind the numbers are strong recurring revenue base. We maintain close interaction with customers and follow up opportunistic growth prospects. The second quarter 2020 revenue increased 160% to euro 28.4 million. Adjusted EBITDA of euro 5 million. Cost synergies moving according to plan. We are now in a phase where we position Infront for the next stage, and it's mainly about post-M&A integration. Common branding of Infront across the geography, aligning product portfolio and positioning the company for the next growth phase, setting up a pan-European sales force and development teams for the future. Infront has a huge growth potential within our existing client base, since many of our customers have still not been introduced to all the products of the new Infront. This is what we call cross-selling. When this quarter started, we were in a quite serious situation with all the insecurity with the pandemic. Some of the sales processes where we were in got delayed, and contacting potential new client was very hard. At the end of the quarter, things got up to speed again, and we won a number of great deals in the few weeks before the summer break. Several of these deals are bigger solutions that will be delivered at year end and also in 2021. So nothing I can talk about now. One thing I can say is that I believe is very important is that a majority of the latest wins is delivery that combines product from both former Infront and former VWD. This tells a lot actually. We see here some examples what we have done. Euronext in Paris is now using Infront for market surveillance because it gives them a great overview of the marketplace and also fast access to all the details when something happens. Davy Wealth Manager and Capital Market Advisor on Ireland is another example where we have kicked out a competitor. It's also very important for us to get the first Nordic buy-side client with a portfolio management system, and we have several data feed sales. I will talk more about the data feeds in a couple of slides. We are now in a stage for the company where improving our margins are more important than growing our revenue. We can reduce costs by having one distribution system, not three as we have today, and also reduce the number of overlapping products so all the very talented developers at Infront can focus on tomorrow's solutions instead of redundant systems. This will take some time, but the reward is significant and we need to think long term. So let me say something about the feed product. This is something that has not been offered by the old Infront earlier, and it's mostly bigger players that offer this since you need a very broad covering to be able to compete. We see that the bigger US players are very active in this area and the price levels are very high. We now have a very solid offering I would like to say more about. Let me first explain what it is. The feed product is a kind of a database access for clients so they can import data into their own solutions, typically to get updated values, but also other information. It can be portfolio system, websites, or a lot of things. So now the content of our feed solution has a global coverage of liquid data with over 120 exchanges, 35 future and commodity exchanges, more than 130 contributors like brokers and banks, more than 600 connected asset managers, that is steadily growing, rating agency, brokers, special data providers, and altogether more than 18 million instruments available. So this is a very strong offering, and this is kind of the same model as our competitors offer. So what we have done on top of this is to add calculated values. So we have a very strong calculation service that can calculate the value of a lot of different exotic instruments and included that in the feed solution. So if you, for example, have illiquid shares, funds, insurance contracts, or wherever it is, it can be calculated a value. Also OTC derivatives, swap, exotic options, agents, rainbows, wherever it is, bonds, OTC bonds and structured bonds, exotic bonds, structured multi-underlying products with special payoffs, characteristics, ABS, and so on. So let me introduce Max Hofer, our CFO, that will do the financial part.
Thank you very much for the introduction, Christian. Q2 was really a very special quarter for everyone, but also for us, with COVID-19 resulting in major changes to how our operations were run from one day to the other, and of course also our customers' operations. Despite those challenging times, I'm very pleased that we can present a very strong result for the period, as both the top line revenues and also the EBITDA increased quarter on quarter. The group revenue increased by 160% year on year from 10.9 million euros to 28.4 million in the second quarter 2020. The increase of 0.7 million from the first quarter to the second quarter is mainly driven by a significant increase in volume-based revenues from our transaction solutions subsidiary in Germany. 98% of our revenues in the second quarter were coming from recurring subscriptions and volume-based invoicing. This again shows the resilience of our business model in volatile market environments. The adjusted EBITDA was at 5 million euros, up from 2.1 million in the same period last year. The margin was at 17.7% for the quarter, still lower than before the acquisition of VWD last year, but as we will see shortly, this is also improving on a quarter-on-quarter base. Despite these challenging market environments, we see a very strong development in the second quarter. The group's revenues increased by 0.7 million to 28.4 million, and also, of course, increased significantly year on year as VWD was included in the accounts. As already mentioned, we have a German subsidiary that profits well from increased trading activity, and this is something that was, of course, a result of the situation in the second quarter related to COVID-19, and this activity picked up significantly, and it has stayed at high levels ever since. The gross profit was up at 18.8 million compared to 6.7 million last year. And we also see that the margins are trending upwards again and standing at 66.2% for the quarter. We believe that gross margins will continue along this trajectory and increase further going forward as our cost savings initiatives bear fruit and we are able to spread the fixed data costs over a larger number of users. The adjusted OPEX increased year on year from 4.6 to 14.1 million in the wake of the recent acquisition. However, looking at the development of the adjusted OPEX over the last few quarters, we can see a downward trend, and this is of course related to the cost savings initiatives that are ongoing, reduced use of subcontractors, consultants, and other reorganization efforts. We believe that this is going to continue. The adjusted EBITDA increased to 5 million euros compared to 2.1 million euros last year, with the EBITDA margin at 17.7% in the quarter. And this is of course also a significant increase after the dip that we saw last year when we included VWD for the first time in the third quarter, and it is in line with our plans and the cost synergies activities that are ongoing. Taking a quick look at the revenue development across regions and segments. The DACH region saw an improvement quarter on quarter as the German subsidiary saw increased revenues from its transaction-related business. The Nordic region was quite stable and saw a slight impact from FX developments quarter on quarter, and year on year it's also a little bit down. The other regions, including our UK subsidiary, is seeing a continued growth, and we think also that this is of course something that's going to continue as more and more sales successes, as Christian has mentioned, are being completed in those regions. The revenue per segment saw a moderate increase quarter on quarter, driven by the UK business, and the VWD segment again saw an increase due to the transaction related business that we have there. The news and other segment was stable. Going forward, we will focus on new operating segments. This in order to make it easier for our investors to follow the development of the different product categories and solution areas that we are offering. We have decided to split up those areas in 3 different areas in addition to group functions. The areas will be the terminal and feed solutions, which is comprising the classic Infront professional terminal, any data and feed solutions, as well as terminal solutions provided from our acquisitions in Italy and Germany. The portfolio and regulatory solutions contain different products for the buy side, such as portfolio management systems, regulatory services, and calculation solutions that are being offered to a broad range of financial institutions. The third area is the media and other. Here it's a really a portfolio of different services and products, such as the TDN and direct news services in the Nordics, but also the media publishing and listing services offered in Germany, and other ancillary activities and solutions across the different regions. Group functions includes group management. It includes administration costs and other operating expenses that cannot be directly linked to the different revenue-making segments, as well as, for example, office rent agreements, etc. Taking a quick look at how this will look like going forward, we have here put together a comparison of Q1 20 versus Q2 2020 for those different segments. The terminal and feed solution hence saw a little increase from 15.6 to 15.9 million euros. And the EBITDA, as shown in the bottom part of the slide, increased from 2.9 to 3.5 million. And this is due to some cost-saving efforts, mostly related to data, as well as other synergies that we have accrued in the quarter. The portfolio and regulatory solutions, we're seeing a stable top line and also margins. The media and other segment increased by 0.5 million euros. And again, this is driven by the German subsidiary Transaction Solutions AG, where we benefited from increased trading volumes. And also we see that this, of course, has a very positive impact on the EBITDA for this segment. The group functions, the cost increase there from 3.4 to 4.2 is mainly driven due to the inclusion of one-off restructuring costs in this area. Moving on to our cash flow in the second quarter. The operating cash flow for the period was a negative 3.5 million euros. There we see the direct impact of the seasonality that we have acquired in the wake of the VWD acquisition. The seasonal net working capital effect was a negative 4.4 million in the period. And in addition to that, we have an interest payment related to the bonds of 1.7 million. The investing cash flow was a negative 1 million, and it reflects mainly the capitalized R&D efforts, as well as €500,000 euros roughly in other investments being made. The financing cash flow of 0.9 million reflects the repayments of lease liabilities, as well as a dividend payment made to minority interest shareholders of 100,000 euros roughly. The end of the period cash position of 18.3 million is hence the result of these movements, and it compares to 23.3 million at the beginning of the period. In summary, Infront has now become the leading European player for financial information software for financial professionals. The company has achieved sustained strong growth of 49% per annum over the past 4 years, with our annual subscription-based revenues standing now at more than 111 million euros annually. With the ongoing integration of our recent acquisitions, we are expanding our product portfolio and are strengthening the position of the company for stronger organic growth. At the same time, these efforts also lead to significant cost synergies. We are very confident that these efforts will result in both additional top-line growth and margin expansion in the mid to long term. And we also seek to complement our product portfolio and geographic reach through M&A, as we have done in the past, and we see very attractive pipeline of various growth prospects. Thank you for your interest, and we will now open up for a Q&A session.